In this episode, some of our Banking with Life clients discuss their exposure to the idea that they could control the banking function with the infinite banking concept and practical experience in becoming your own banker, as taught by my late friend and mentor, R. Nelson Nash. Now, these are unscripted and in their own words, so they may not use precise language, but they took time out of their busy lives and their full schedules to come and share with you. And I thought it was very powerful. They were very complimentary of us as a team, the Banking with Life team, and some of the team members, Jake, Julie, Service, and I do truly appreciate that. But those were also unsolicited. I really had fun with all of these individuals, and I think that you'll enjoy. Thank you for listening.
Yeah, it's just, but the point about mentioning Allison, mentioning taxes, mentioning her world, but really for the general public, and really just, I'm looking at our family. We know the biggest expense we will ever have is taxes. So these life insurance policies help tremendously with that. So, along with the compound interest and so forth. But how do we integrate, back to your question, how do we integrate with real estate? Yes. So I left the banking world because of investing in real estate, and we don't, our primary focus, we invest in apartment complexes. That's what we do as a family, and it's just a skill set. You learn from other people. I'm with a group that are a bunch of educators and mentors, and it's a large group. Anybody can be a part of that group, but again, it goes back to the discipline and self-motivation to get educated on this. And I think a big mantra of that group is real estate isn't hard, people are hard, right? So if you can learn the skill sets and do what these sort of educators and mentors of this group, it's a tremendous group, and I've learned quite a bit. If you can do what they say and just implement these disciplines, you can be disciplined, and you can invest in these things and be successful. So how do you implement the becoming your own banker with investing in apartments, or I guess investing in anything? You can use, because you can borrow from yourself over here from this whole life policy where you're still making interest and dividends, because the insurance company, as it turns out, if it's the right kind, will put a lien on your money, but they're going to lend you their money.
Sure.
And so you're going to take their money, and it's tough to get a loan from your own policy. It takes one signature in about 3 or 4 or 5 days, and you have a loan. So I say that sarcastically, because I'm coming from the banking world, where every year I always say there's about 10 more pages added on to those mortgage loan not applications, but closing documents. I mean, they're that thick.
Oh, yeah, no, wait. And when you get 3 or 4 investment properties, now you're going to have to cough up some pro formas, K1s, 2 years tax return. All of that's got to be up to date to get the next
And
loan.
You better have 2 years of positive global cash flowing real estate before they'll use it for your income, or don't even show it to them. Right. So, and you got to have proof of that. So you can take, if you're going to invest in anything, you can view that as your own business. When you invest in real estate, you must view it as your own business. It is a business. Whether you're going in a single family, whether you're investing in a commercial building, or whether you're investing in apartments, you could also invest in someone's new business or your own new business.
The banker
can fund that. Yeah,
the banker can do anything they want. All right, when you have capital, access to capital, and I think a benefit or even a discipline that comes along with the infinite banking concept over time, when you have access to capital and easy access to capital, that kind of helps you hone your skills, you, the investor, hone your skills on evaluating investments. Now, you think about this for a minute. If my capital is over here and it is doing very well where it is, and I have access to it, any investment that shows up, because capital does attract opportunity, all right? So all these opportunities show up. So I get the ability to hone my skills in vetting an opportunity, right? If capital can't do better in that opportunity from where it is currently, I'm not going to take advantage of that quote unquote, air quotes, opportunity. Does that make sense?
It does. You have to be educated enough to understand an investment opportunity, and you'll get educated if you're going to your own self to finance that, right?
No question.
And I also, I don't know if I heard this, or this is how I think, in terms of when you have capital that you can invest in opportunities, you will run out of money before you run out of investment opportunities. There are always opportunities when you have capital. How do you position yourself to take advantage of those? Well, once you do it once, I've seen and heard people who might self-finance, right? So I could theoretically take money and borrow from my policy, and I could lend it to someone who's going to use it to buy a house.
Hard money lending, huh?
Private lending, right? Do you really want to do that? I don't know. You're going to run a credit and criminal check on that person, or is it a buddy? Is it family? I don't know. I don't know what you want to do with it, but you're going to take more steps to vet that situation because you want a return on your investment. But you'll run out of money before you run out of opportunities. Yeah. So the thing that I've implemented for us and our family, and we have got to take steps to fund, to capitalize. It just means put money into our life insurance policies to have the capability to get into these investment opportunities. Investment opportunity can mean anything. But if we don't have that capital, we're not going to be able to invest in that opportunity.
Right, you're going to be stuck at the mercy of the third-party lender, right?
Right. Right. That's right. You are going to be at the mercy of a third-party lender, and no one reads that fine little typed. No one watching this reads that paperwork that a bank has you sign, because most people are nervous when they sign loan documents.
But this is not the end-all, be-all investment. You can get your money out of these things to invest in whatever it is that you're interested in. And that goes back, hey, invest in what you're interested in. I'm interested in oil. I'm interested in cattle. I'm interested in construction. I'm interested in building spec homes. That's what I use my policy for. So it does not preclude you or exclude you from doing whatever it is your investment style happens to be. You can do whatever. But do something. That is the challenge that I will put out to whoever listens to this. Do something. Whether it's get with James and decide it's not for you, or get with James and decide that it is everything that you hope it could be and you move forward, do something.
I like that. James is choice A or choice B.
But hey, I don't want to sit here and say, get with James and do this. I don't want to be that salesman, James.
Sure.
You're not you are in a sales position. You have to show people the benefits, but I will tell everybody listening right now, I do not look at James. Let me talk to you, James. I do not look at you as a salesman. Right. I was never sold anything. My questions were answered. My education was confirmed. You helped me set this business up. You, in my mind, are not a salesman. A salesman is when you walk onto a car lot and they are pushing something down your throat. James, you never did that to me. I appreciate it. I know you don't do it to your other clients. They're going to appreciate that. And I know you don't do it to new people. So do not expect to get sold something. Be expecting an education and guidance. And that's what I want people to understand.
Thank you for saying that. I hate being pigeonholed. I'm a father, a son, a brother, an uncle, many things.
Yeah, but. Absolutely. Other than that, James, I think we could go on and on. There's many scenarios that I could talk about. I could bring up questions that I've had that you've answered. But I think that for the purpose of what we're trying to do here, people have heard my story. They've heard my experience. They've heard some of the things that I faced, which was skepticism, research, all of these things that I know everybody is going to go through to some extent, I can tell you that I made the right decision, and I know that based on what I'm doing in my life right now. And I couldn't be happier financially, or with the financial instruments that I'm involved in. I couldn't be happier.
Perfect. Well, that's I just appreciate you sharing, Adam. That's really what I want, is just for you to share from your perspective, and I think you've done a very good job of that, and I appreciate you taking the time and to even do that with us, so thank you very much.
Absolutely. Well, I think it is important enough to let people know. I'm not out there pushing this every day. I'm not trying to convince the world, and maybe I should do a little bit more, but that's just not me. And so just to let people know that the fact that I'm on here talking to people about this, it's kind of out of my wheelhouse. I don't normally do stuff like this, but it is an important enough thing in my mind, and something that has helped us tremendously, that I agreed to do this, and I want people to know that it's something very beneficial, that it's not just for rich people. It's not just for people that have a bunch of expendable income. It is for everybody. I think that any policy can be set up for any income level, and that they will be better for it. And I want people to know that this is for regular people as well. So
I agree. Thank you. All right, Adam. Man, I just appreciate you.
James, I appreciate you guys for sure. You guys have helped me out a lot. So.
But if you look at an even distribution of age classes in Nelson's book, and I believe it's on page 70 and 71, right? Nelson uses 4 different generations, right? And it's the older generation that has all the money, right? It's the grandparents that have all the money. And so and I don't want to make too many assumptions, but I think it's safe if you're a grandparent, or a lot of people in their 70s are grandparents. Okay, so I just want to look at that. Age 70, I'm a grandparent. Am I too old? The short answer is no. But are you insurable? And yes or no, you may be or may not be. It doesn't matter if you're insurable or not, in my opinion. Because if you consider what's going on in an even distribution of age classes, if I'm 70 and I want to implement the infinite banking concept, if I'm insurable, I can start on my own life. Right, but that is a death benefit focus. You're still going to have cash value, but you're not going to have the same cash value in 5 years as you were if you were 20, 30, 40, or 50. All right, does that mean it's a deal breaker? Does that mean it's an end-all, be-all? No. If you start at age 70 and you're insurable and you start on your own life, you're just starting, you're kick-starting, you're accelerating the legacy, the foundation of building, the infinite banking concept through more than one generation. Because look, we're all going to graduate. Nobody's going to get out of here alive. I think there's only been 3 previously, and you're not going to be the 4th, and neither am I. Okay? All right. So, if you're insurable, you can start on your life. You don't have to finance a single thing, right? But then you can also potentially purchase policies on your children, or at least lead the way, show them how to do it. And you can look at your grandchildren, right? So you can lay the foundation if you're insurable or if you're not insurable, as long as you have insurable interest in others. Either way is okay. And so I'm sharing that sometimes when we're older, we just think, well, it doesn't apply to me, or I can't do it exactly like I've seen some example in the past. That doesn't mean you can't deliver, legitimate, real, life-changing results to your prodigy.
There you go. Now, once you have them set up on the kids, you can use it as a way to get the kids introduced.
What? You mean your children, like my children, may be interested in money?
Right.
What?
All right, I'm not going to say this really loud. My son is over in the other room. But,
Okay.
all right, he may need a car soon. Get a car loan through the policy. Show him how it works when we do it. Have him make a payment to us, right?
Yeah.
The exact amount that the loan payment would have been. See, right there. Your kids will always think you're a dummy. That's sad, They have to see it work.
Sure.
For it to be a good idea.
Well, I appreciate the automobile example. You're just not going to go far unless you live in New York City. And the last I looked at New York City, people are leaving by the droves. So unless you're in New York City, you're probably going to need a car, right? Okay. So you bring up the car, and I hear often it's like, well, James, I can go get a brand new car financed at 2.9 or 0 or 1.5 or 1.6 or whatever. I'm like, man, that's great. Most policy loans are 4.76 all the way up to 8%, depending on the company. And at the end of the day, I don't care. So why, James, wouldn't I use, the third-party lender's money at 2.9 versus borrowing from the life insurance company at 5? And at the end of the day, that's just straight math. 2.9 is a smaller number than 5.0. No kidding. No kidding. Okay, well, why might I consider that? Well, maybe I don't want to jump through the banker's hoops. But if I'm willing to jump through the banker's hoops, I'll use all their money that they'll lend me at 2.9%. You know what I'm saying? So it's my choice is my point. It's who's controlling the banking function. All right. And then I might say, when's the last time you've had a pre-owned car offered to you at 0 or 2.9 or 3 or 4 or 5% interest? Never. It ain't going to happen. Here we are in the lowest interest rate environment ever. You're not
normal.
Yeah.
It ain't normal.
And then what's it? Your children need cars. My children need cars. And if the bank, the third party lender bank is going to charge 5, 6, or 7 for a pre-owned car, and my company, the life insurance company charges 5, and if I charge my children 7, let's say, that additional 2% goes into a policy that I own, and in your case, it's on the children's lives.
Yes.
That's just additional premium to the life insurance company. So, right, we're calling it additional interest in our arrangement based on the market rate of interest by the third-party lender. But that additional money into your life insurance policy creates greater cash values immediately, a greater dividend immediately, and greater dividends in the future forever. I mean, so my point is, if your son listens to you and pays attention to you, and I hope he does, and he repays the loans on the terms that y'all have created, he's just creating more money for himself in the future because you are going to graduate, and that policy is automatically going to transfer in ownership to him.
Right.
And it's going to have more money in it.
My approach is also, because it was like my hook, the thing that hooked me, right?
the brute force. It sounds like brute force, man.
You're recovering all the principal payments.
What?
And you're putting it right back in your own account. Right?
Yeah, I call it the equivalent. You're recovering the equivalent cost of the car.
Right. So I can show him that side as well. Right. This is the interest you earned, and look at this. This is the principal payments you recovered. Wow,
it's like, what's wrong with that? And nothing is wrong with that. And if you look at the last, I've done lots of calculations in the past, lots of different presentations, but the average all-American family winds up spending well over $1 million just for the privilege of driving a car throughout their lifetime. And the question always got down to how much of that, or if you could recover the equivalent $1 million, that you spend on cars for the privilege of driving. If you could recover some or all of that, would you want to? And, well, yeah.
Yeah.
And then, well, when would you want to start? Immediately. That's 5 months from discovery, hearing about the idea, beginning the learning process, and then going through making even contact with us, and then going through the application, the underwriting, the delivery, funding, paying the premium. It's all conversation till somebody writes a check. You write the check, and then you get loans to send creditors down the road, packing, send them packing.
That's right.
That right there is somebody who's made a decision to move forward and then put their hand to the plow and didn't look up. So good job, sir.
Thank you.
You're welcome.
Thank you all.
That's powerful.
Yeah. And I think I've already maxed out my policy.
Right. Well, maybe we can work on a second one. I don't know.
I have to wait another year, right?
No, you don't have to wait by a year. No. I don't know.
Okay.
If we conveyed that, that's not right. You can buy. No. We're all only limited by our age and our income, right? So the total death benefit that any of us can have is a factor of our age and our income or our net worth. Maybe I don't have an income, but I'm worth, $500,000. I can have 1 times my net worth in face amount. Then you just work backwards from there. How much premium can I pay without exceeding that limit? But no, you could if it makes sense, and it's got to make sense. But you can buy more than one policy in a year, no question. Yeah.
Okay. Well, I maxed out this one.
Good job.
I attempted to click in $1,600, but it only said I could put in $1,361. And so I kept running. So I called the company and said, "Yes, sir, you about maxed out." So I took the other $300 and put in Bit's policy.
Perfect. Yeah.
Put hers in. So, and I think if I'm not mistaken, I think Emily said that she could put in. Well, what would be took out for the next 4 months? September, October, November, and December will be $1,900.
Perfect.
For Betty. And so we should have that by November.
Oh yeah, make it happen. All right.
So, because of my son was 3 years older than my daughter, his policy, and I put the same amount of money into each of them each year. His initial policy was about $300,000 less than my daughter's, but my daughter's now 18 and my son's 21, and I just checked. Currently, my son's death benefit is $1,371,000. My daughter's is $1,846,000. I'm limited now how much I can put into the policies. As a matter of fact, I just paid my daughter's base premium, which is $4,000, and the company actually is going to text me in the next day or two of how much I can still put to the POA rider, but it's not a lot anymore. But their cash value increases. My daughter's cash value increase this year was $12,000. My son's was $11,000. And even though my son's death benefit is a lot less than my daughter's, her cash value is $99,000. My son's is $102,000 currently. Now, what I've done over the years is I gift each child money into their separate bank accounts and then pay the policy premiums out of those separate bank accounts so they have a basis in their policies. So when I plan, hopefully if I live another 10 to 12 years, I plan on giving the policies to them around age 30. I figure by that time they'll have enough wherewithal that they'll understand the banking. And by that time, my daughters will have pretty close to 300 some thousand in there. My son will have 280 or so. Actually, pretty close to 300. I was sort of surprised seeing that their cash values are equalized, even though their death benefits were so much different. Now, I've also, one of the things that I've sort of put into my trust agreement is that when they get the policies, they need to keep these policies as personal property if and when they get married. And that just...
Yeah, so there's some ramifications to that. There is a proper way to gift money, even to minors, so they do have a basis. And then there are underwriting requirements. Mom and dad have to have X number of dollars in base amount from all sources. There's some limits, but, it all can be done.
Yeah, we had large policies on my end.
Yeah, y'all started correctly. You started on yourself several times over, then went to the children, then came back and, their mom. And, which is all a good job. So if you just extrapolate that out, you're talking about long time periods, and we may not be here. I love to talk about 50-year timelines, which is kind of a long timeline for a Westerner. In Asia, they think generations ahead. So what? I'm not going to be here. Neither are you, but your people will be. So, why not? That's really part of the problem. In our thinking. It's like we're just thinking short term. We often think short term and then the immediate results, and that has all kinds of consequences. Some are not life ending or a complete train wreck. But the longer term I think, the better I think I can lay the solid foundation. I truly believe that. But your children, talking about your winning on cancer now, and you hope to live 10 or 12 years, and I hope you live much longer than that, but they're going to have a real problem. When you graduate, there's going to be an influx of tax-free money, and that's a whole new problem. Where are they going to put it? So leading the way and showing your children and your prodigy this idea and help them embrace this concept. They should be continuing to buy policies, because of the children and that at that time, you're limited to mainly a base premium, which there's nothing wrong with that. So either they've got to go buy more they'll have to buy more policies because of the amount of death benefit you have in force.
And my trust is set up that if they have kids, the trust will pay the premiums for their kids. And then, so it'll pass on generationally for a while. So,
that's pretty powerful.
Oh yeah. And all I can do is thank Nelson for being there. And like I said, I read a lot, and there's a lot of books out there.
Well, it looks like we got a whole slew of them on the table here. Not all of them, but there's a lot of them.
And I've read a lot of books from IUL, UL, equity indexed life insurance. And the big thing that you learn, and I read these books and I see what people do, and it's like everything else. You take the good with the bad. I can learn from anybody. But what happens is you have dividend paying whole life insurance through a mutual company, which Nelson considered the best product out there. And then suddenly you've got universal life that has a term component that basically what's happening is the insurance companies is transferring the risk from them to the owner of the policy. And
violating the very nature and the very essence of insurance.
That's right.
I'm transferring the risk to someone else, and they're universal life. The companies transfer the risk right back to you.
And equity index policies are even worse.
That's exactly what I'm talking about.
Because they're putting you at risk with the market. And it's the life insurance companies love it.
But what I found in my experience, because I am a high income individual and I have, income from multiple sources, I was like hitting the MEC limits on my policies like within the first, year and a half. And so I needed more places to put this money. And so I was like, I remember in the book, even distribution of age classes. Oh, what about mom and dad? What about son and wife? So son and wife were next. Mom and dad were after that. And now I'm in the process of getting another policy on myself. And having to deal with my own doctor's office as a barrier to getting my next policy, which is amazing. That, you know, you never know where you're going to bump into the next bureaucracy, James, but it's just around the corner. It's just around the corner. Don't worry. But we're going to overcome that. And so it was the foundation of what Nelson put, and thinking about trees when it's so easy to understand, because Nelson said, you know, he spent 10 years as a forester, and he described the process of how you put trees into a grid system so that you can, you know, pick, prune, and harvest at different times of year from different sections of the forest. And we kind of do the same thing where we people are like the trees that get harvested when we graduate, pick and prune as life happens to you. And I thought, this is so simple, and this pattern follows nature. This is a very easy to understand pattern. And if I put this in place and teach my son and my wife, no matter what happens to me, they'll be able to do this and replicate this. So I actually have some really intentional. My son's 13. We've had some, and like I said, we've been doing this for 5 years. Some years ago, James, he even wanted to get a smartphone. And this, you know, we're the type of parents who are like, yeah, you're going to be responsible for it. So I said, you're going to buy your phone using cash values from the policy that on you that I control, and you're going to pay that back every month with income that you're getting from allowances and a little bit of work you're doing. And he ended up paying that phone off early. And now, fast forward to now, we're getting new phones, because that's what you have to do in this world, James. You know, everything gets recycled, and we're going to have to get new phones because they become obsolete. And so now we're getting new phones. We're doing the same thing again. And of all the phones we're turning in, his actually has the highest value. So I told my son, like, your new phone is the cheapest because you got the biggest discount because you paid your phone off early and you've owned it for a long time. So congratulations, son. You saved the most money, you know, between among the three of us. And so he's going to get the same phone as mom and dad. So all three of us are going to have the same exact phone. And, you know, he's 13. And some of his friends have like what I would just call burner phones. Like, they can only do like limited things. And, you know, for whatever reason, how their parents are doing it with their kids. But it's like, this is just cool that he can learn how to finance it, because he's still financing it through his system, and he gets the benefit of having it. And when he paid it off, I showed him, I said, here's what your policy was forecasted to do if we had not used it. And here's what it's doing now. Like, when it started, James, the death benefit was less than $1 million. And now, just with a little bit of usage, the death benefit's now over $1 million. And it's grown, and it's growing, and it's outperforming. So I'll say, like, every policy that I've had is far outperforming all the original illustrations because of what I've done with the policies.
Thank you for joining us on the Banking with Life podcast. If you're watching on YouTube, make sure to like and subscribe and click on that little notification bell. Otherwise, join us on Apple Podcasts and Stitcher for weekly content.